Applovin is one of the more interesting AI stocks for investors to consider. The stock has gained significantly in recent years following the advancements of its AI technology that helps app developers monetize their creations. But is Applovin stock still a buy, or is it time for investors to take profits after the significant stock price increases? Well, I'm going to update my recommendation here for Applovin stock. If you didn't already know, I've had Applovin stock rated as a buy all year long, and I'll update that recommendation here in this video and let you know if it's still a buy or if it's time for investors to lock in these gains. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So one of the reasons why Applovin's stock is surging here in 2024 and from 2023 is because of the fundamental performance metrics of the company. Revenue, profits, cash flow, all of which are increasing phenomenally well, and it's leading to big stock price gains. In the second quarter, the company generated $1.1 billion in revenue, which was up 44% year over year. Net income of $310 million was up 286% year over year, and the net profit margin increased to 29%. This is NVIDIA-like numbers for Applovin. Revenue, 44% growth, profit, 300% growth. These are really good numbers for a company that's not on most investors' radars. You can see here, year-to-date, Applovin stock is up 261%, reaching phenomenal gains that exceed that of NVIDIA and most other AI stocks. As I mentioned, I've had Applovin stock rated as a buy all year. I last updated that recommendation on September 24th. But I've been getting a lot of questions from investors asking my opinion on Applovin stock again. So I wanted to update this recommendation here again today, and I'll let you know by the end of the video if I think the stock is still a buy. In addition to the net margin and all of which increasing, the company's cash flow from operations increased by 98% to $455 million, and free cash flow increased by 102% to $446 million. These software-based business models can be incredibly lucrative at scale, and that's what Applovin is demonstrating. Their latest enhanced Axon technology is really proving useful for developers and those using its technology and services, and people keep spending more and more on the platform, and these are coming at higher and higher profit margins because the company already spent the money to develop this technology, and each incremental customer adds significantly to its bottom line and its cash flow. One of the more interesting things the company is doing with that cash flow that it's generating is retiring a lot of the shares outstanding, reducing the share count. You can see the chart here, shares outstanding in the purple, going from 348 million shares outstanding down to 334 million shares outstanding after a recent uptick here. Companies like Applovin use a significant amount of stock-based compensation, so if they're not using their cash flow to buy back shares, it can be dilutive to investors, and the increasing share count could have an impact on the company's bottom line because then the net income needs to be split among more shares, which then reduces the earnings per share because there's more shares that need to be split. Now, looking ahead over the next 5 years, the Wall Street analysts that are following Applovin stock, they think the company will grow their earnings per share by roughly 20% each year over the next 5 years. And I think this is a pessimistic outlook. If I had to take the over or under on this number, I would take the over. Management has forecasted that the company is going to grow revenue at about 20% per year over the next couple of years. And given the economies of scale established in the software-based business model, if it's growing revenue at 20%, then earnings are going to grow at much faster than 20%. Next year, Wall Street is more optimistic. They think it's going to grow its earnings per share at 30%, but it looks like they expect the company to settle down and experience a slower growth rate after next year. It'll be interesting to see where the company actually settles down in terms of their long-term growth rate, but I think it'll be closer to 30% instead of 20% over the next 5 years. But remember, these are all forecasts and estimates, and nobody really knows what's going to happen in the future. We can just use the numbers available to us to make our best forecast for where we think the company's earnings per share will go, where we think their sales will go, but nobody knows what's going to happen in the future. So take these estimates for what they are, just estimates. Now, given the significant rise in Applovin's stock price, the valuation has also increased. It's now trading at a forward price to earnings of 25.5, and that's up significantly from where it started the year. It was trading at a forward price to earnings of around 10, and I felt like the company was a great bargain at that time. And now it's trading at a forward price to earnings of 25, which is not as great a bargain as it was to begin the year, but I still think it's a good value. I still think at a forward PE of 25 for a company that's growing its earnings per share at 30% next year, somewhere between 20 and 30% over the next 5 years, given the software-based business model, given the advertising industry it operates in, it's a massive total addressable market of close to $1 trillion. I like the company's prospects. I like the company at the current valuation. So to update my recommendation of Applovin stock, I still think it's a buy, even though I'm not as bullish on this company as I was maybe 2 months ago or 4 months ago or 6 months ago when the valuation was much cheaper. The company is supporting the increasing stock price with increasing profitability, although the stock price increases are faster than the company's profit increases. So the valuation has gotten a little bit more expensive compared to the start of the year, where I shouldn't say a little bit more. It's pretty much doubled in the expensiveness of the valuation according to the forward price to earnings. But given its prospects, I still think the stock is a buy, even though, like I said, I'm not as bullish on Applovin as I was a couple of months ago. Still, for long-term investors, I think it provides the company a good value for the risk that you're taking. And you can see here my list of stock recommendations. I have a ranking system where I have rankings from where I say something is the top stock to buy. If you didn't already know, Alphabet is rated as my top stock to buy in 2024. And then I have on my list of top stocks to buy, I have ratings of a buy, borderline buy, hold, borderline sell, and top stock to sell. So I have a different ranking system, and you can see here some various stocks on this list here that I've rated, and I update these frequently as I conduct research on a daily basis. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.